On behalf of Quantum Business Law, we would like to give a very warm welcome to our attendees, many of whom are regular viewers and many of whom are here for the first time. So welcome to everyone. Today, we're going to speak about some topics which are very concerning for successful business people and wealthy Canadians alike. We're going to discuss the federal government's budget and tax proposals. Also of interest to our advisors and business owners watching today, we will discuss what types of planning strategies we can recommend to our clients or implement for ourselves now in 2021, going into 2022. Of course, the information presented in this webinar today is for educational purposes only and is not legal advice. Now I'd like to take a moment to introduce our expert panel. We have Todd Louie. He's a partner at Quantum and he's the head of our tax group. Michael Miller, he's also a partner at Quantum and he's the head of our litigation group. Next we have Lorne Saltman. He's the head of the tax group at Gardiner Roberts. He's also counsel to Quantum and he's a good friend of our firms. Mahyar Makki, he's a tax partner at Quantum Business Law. And I'm Jeremy Louie, also a tax partner at Quantum. Without further ado, we can jump into our program. So we're going to share PowerPoint for today. We'll start just with a brief overview of our agenda, then we'll jump right into the material. So we're going to spend the first 20 minutes speaking about some 2021 tax proposals that we think are pertinent to our business owners and wealthy individuals. Then we're going to spend 10 minutes talking about succession planning and Bill C-208, 15 minutes on some planning strategies for wealthy Canadians, and 15 minutes on tax efficient uses for corporate funds. So that's our program. Why don't we jump into the next section? So this is the first part that we'd like to discuss on the tax proposals, beneficial ownership transparency. Maybe I'll ask Lorne to give us some background on this and jump into it, please. Lorne.
Sure, thanks, Jeremy. The federal government, following the initiatives internationally of the Organization for Economic Cooperation and Development, the OECD, is in the process of implementing a number of very significant changes to combat what has been described as international tax evasion, improper shifting of profits from high tax to low tax jurisdictions, the obfuscating of ownership of companies, trusts, and other types of entities. All of those, there are significant changes in all of those areas. Let's start with the enforcement and administrative area. Currently, the Federal Canada Business Corporations Act has taken the lead in Canada in requiring the disclosure of beneficial ownership in private corporations. Currently, the access to that information is limited, as the slide shows, to the director under the Canada Business Corporations Act and persons who are shareholders or creditors, so long as the request is related to a matter in connection with the affairs of the corporation. But the significant change here is the government is proposing that beneficial ownership be available to anyone in the public, and there is no protection for privacy or confidentiality. There is no recourse provided in the legislation to challenge that, and so it's something that is about to come next year that we should all be aware of in terms of the government's desire to show who the true owners are of various corporations. So let's go to the next slide then on mandatory disclosure rules. Here, we want to talk about an extension of the same kind of desire for transparency that the federal government is proposing. And again, that this is to a great extent being pushed internationally by the OECD. Currently, in the Income Tax Act, there is a set of rules that requires disclosure to the Canada Revenue Agency of what are considered to be aggressive tax plans. And here we're looking at proposed changes to broaden the scope of what are considered to be reportable transactions, which we'll go to shortly, and something new called notifiable transactions, which is more importation from the US. And then another importation, the requirement to disclose uncertain tax treatments. So let's look at the next slide.
If I could chime in before we go too
Sure.
far.
Sure.
I want to talk a little bit about these things, and Lorne, I don't want to interrupt your flow, but I will say that, you know, there's always a balance between privacy and also protection from, I would call victims. And of course, depending on the definition of victim, well, we know that notwithstanding organized crime and other criminal activity that can be used through shell companies and nominee corporations to buy assets, as in the first slide, I'd suggest that there's an enormous push, as Lorne mentioned, by the OECD, on account of about $250 billion in lost revenues because of not knowing who these individuals are. So as much as we do obviously cherish our privacy, well, that's coming to an end. And I suppose it's a double-edged sword, is my comment. I wanted to further comment on this whole issue of reporting. And one of the really profound things comes from this whole issue of reporting specific types of transactions. And, you know, there's various different manifestations that might take. And in particular, there's a recent case that involved transactions that are referred to as straddling. Well, of course, that may be one of those new hallmarks that come about, whereas people that might be doing something that could be perceived as that type of planning may well have a requirement to report that kind of a transaction. Anyway, Lorne, go ahead, please, jump in.
Okay. Just to touch very briefly, the figure of 250 billion or million, Todd, that's a guess. Nobody really knows what the tax gap is. And I'm going to suggest it's much less than what is being proposed. Those of us who have been around for a few years in planning know that it was very common years ago to use aggressive tax strategies domestically and internationally. And gradually, and now picking up pace, the international rules are tightening. There's much less availability of hiding the ownership of international and even domestic corporations or trusts. And the CRA is extremely knowledgeable and aggressive in combating these things. So in my view, a lot of what we're talking about today is overkill because the problem is not as great as it's purported to be, but a lot of it is also political. With that statement, let's go into a little bit about reportable transactions. So right now, there are 3 potential hallmarks that indicate that somebody is advising a client on a transaction which has to be reported, or a client is participating in such a transaction. And if 2 of these 3 are present, it's a mandatory requirement. The first hallmark is that a promoter or advisor is entitled to contingent fees. In other words, the fee is payable based on, let's say, the tax benefit that is derived by the client from the transaction. or it's maybe attributable to if it's a syndication, the number of taxpayers who are participating in the transaction. And so the fees are dependent upon some factor like that. That's a contingent fee. Then the second hallmark is confidential protection. Well, let's say that a tax advisor feels that he or she has come up with a unique plan and doesn't want it marketed around where other people use that information, so requires the client to sign a non-disclosure agreement. That is confidential protection, and it's the second hallmark that we've got to be very wary of. And then the third one is confidential protection. So what that means is, let's say that a taxpayer has entered into a transaction and is given a guarantee or some kind of insurance arrangement in case the tax benefit falls apart, they don't lose out. And that's the third hallmark. If any two currently are present, it's reportable. The proposed changes on the next slide is to make one hallmark enough. So let's say you simply have a contingent fee. That's going to be enough to require the taxpayer and the promoter to report within 45 days of the transaction taking place, or be subject to penalties.
I would just like to comment on this whole issue again, dealing with reportable transactions. And the fact is that when we do effective and responsible, conscientious tax planning, we have really nothing to hide. It's not a matter that we're hiding anything. But the point is that if one wanted to be critical, it doesn't take a genius to do so. Anyone can be critical. And when we're doing planning that might be misunderstood, well, there's always a risk that someone somewhere might disagree with what we're doing. And one of the risks that they may decide to apply is what's called GAR, General Anti-Avoidance Rules. And essentially, a GAR is applied where we have not directly offended a statutory requirement or regulation. It means that CRA does have the capability under certain circumstances where there's no purpose other than saving tax, where there's an abuse or misuse of the legislation, and where there's a tax benefit to apply that, which puts certain kinds of planning at risk, particularly the more complicated planning that we like to do. I'm joking. The fact is that understanding what's being done is important. When we think about the Panama Papers and other highly publicized abuses, well, we legitimately wish people wouldn't do things that are aggressive. We implore them not to. That's our position. But we're staying within confines is never a good thing to necessarily attract attention. So one of the issues might be is, as an example, if you're being asked, well, give us your view of this. And if our view happens to be that, that this would stand a test, well, I don't really know the answer, but I guess the question could be, would that be some kind of a warranty that's being given? Or perhaps there would be a fee that's based upon success that would make sense for business purposes, which no longer may keep this away from the scrutiny of individuals who might have an issue. But I think more importantly, what has to be done must be compliant. It has to be done in a way that we're considering not only the law itself, but the statute, the sensitivities that CRA, as an example, may have to certain kinds of planning. And at the end of the day, this ship that we're sailing on together as we navigate very, very difficult waters is not only governed by tax, it's not only governed by what might sound good for someone else, but what's good for each individual client. And it's the likes and the dislikes and the tolerance for risk that has to factor into that.
I'd like to add something. Can we go back to one slide, please, Jeremy? Yeah, I've mentioned one hallmark, but in right at the end, we mentioned that the definition of avoidance transaction for this purpose is going to be amended so that a transaction is considered an avoidance if one of the main purposes is to obtain a tax benefit. Those of us familiar with GAR that Todd mentioned earlier may remember that an avoidance transaction under GAR is one that is undertaken to obtain the tax that would result in getting the tax benefit unless the transaction may reasonably be considered to have been undertaken or arranged primarily for bona fide purposes other than to obtain a tax benefit. So this is a different rule. It's to say one of the purposes is to obtain a tax benefit. It's very broad. So one hallmark and one of the main purposes are significant changes to broaden the reporting requirements here for what are considered to be aggressive transactions.
I'd just like to point out as well that, our tax system, and particularly regulations and laws and regulations that revolve around general anti-avoidance, is in effect woven on a fabric that allows for tax planning. Tax planning is not a bad word. If an individual is able to arrange his affairs in a way that results in paying less tax, that fundamental principle is still preserved within our tax system. That is a backdrop. And the way that CRA decides they're going to apply this may or may not be successful. It's another thing to keep in mind. CRA doesn't make the law, they interpret it the same as you do and I do and anyone else.
Very interesting, gentlemen. I think we should move on to the next topic.
Notifiable transactions. This is an outgrowth of what we were talking about earlier, but mandatory reporting. What is a notifiable transaction? We don't know, but we're being told that the Minister of National Revenue will have the authority to concur with the Minister of Finance and decide if a particular type of transaction is notifiable. And there'll be some examples presumably published to tell the public what they're focused on. And if your transaction is similar, you're going to have to notify the CRA in the same way that the earlier discussion about mandatory disclosure of reportable transactions requires. But it's very uncertain as to what those are going to be. So let's go to the next slide. And this gives the timing requirement similar to the mandatory reportable transactions. And then the next slide.
I just like to point out, I just wanted to point out before we go race too far on this subject, I'd like to say that, notifiable transactions, although as Lorne correctly said, we don't know what they are. One would imagine when there is an established case that may have the effect of creating new law, good law, common law that's based on Tax Court of Canada decisions, Federal Court of Appeal, perhaps the Supreme Court of Canada. It doesn't necessarily mean that the wind happens to be blowing in a different direction today, and it may, or the moon is in a position on the sky above us that causes one to make a decision that would be enforceable for reportable transactions. It's not to say that this is correct. It's to say one would expect. As an example, there are court cases that might happen where judgment is made by the court that establishes certain facts. One of the things you'll hear about today is actual control versus de jure control of a corporation. Well, that's an example of how law evolves in Commonwealth jurisdictions, and to the extent that courts make decisions that affect the way that all of us need to interpret the law, one would hope that that would be the guiding force in determining these what is a notifiable transaction, what is not.
Okay, so let's turn to uncertain tax treatments, particularly in the United States. This movement started a few years ago with public companies having to disclose in their financial statements if there were provisions for taxes that may become payable. There was a requirement to explain why they thought internally there was some doubt about the position. Well, now we're looking at expanding that concept, bringing it to Canada and imposing it across the board. And these are, with the 4 bullet points at the end, the links to determine which corporate entities, private and public, have to disclose uncertain tax treatments. And that means that the company's internal and external advisors have to determine whether a particular position is doubtful. And if the CRA were to look at it, that it has a likelihood of failing. So which corporations are there? Well, first of all, domestic corporations, but also foreign corporations carrying on business in Canada that have to file a Canadian tax return. That's the first component. The second is having at least $50 million in assets of the group of which the particular corporation that's being audited is being examined. And then the third is that the particular company in question doesn't just have informal financial statements, but they have to be audited. And finally, there has to be, and just to stop for a second, audited, but in accordance with generally accepted accounting principles, the international financial reporting standards, and so on. So now the last bullet point, the uncertainty in the tax treatment is reflected in those audited statements. So the entity would be concluding that if the CRA were to look at it, they may not accept the interpretation and that there could be a disallowance, let's say, of expenses. And if we find that all of those elements are present, then starting next year, it's going to be mandatory to disclose in the financial statements the position internally. And that is a judgment that some very conservative, careful people may put in the financial statements, but if actually tested in court, may turn out to be wrong. It may be that the expense was deductible. A few years ago, the CRA wanted to audit a company and obtain the working papers internally that were prepared by internal accountants with the assistance of outside accountants. And the case wound its way through the courts because the corporate taxpayer objected to it, saying that the CRA has the right to get information, but this is just our view. It's not what the law is, and then let them make their own decision. Ultimately, the Federal Court of Appeal agreed with the taxpayer to this extent that the CRA does have the power to require information relevant to the administration of the Income Tax Act, which could include internal statements, but it's not unlimited. And CRA has to make its own objective determination of whether a tax position is justifiable or not. And in this particular case, there was no justification for requiring the taxpayer to show the internal working papers. So that was a problem for the federal government. And so we now have these potential disclosure rules of uncertain tax treatment, which will require working papers with the subjective view by the corporation having to be disclosed to the CRA.
I'll just amplify a little bit on this, and I'll also put it in some context. I think that the starting point when we consider this entire issue about the these unpredictable positions that might be unknown as far as the result from a tax point of view is that we happen to live in a country where self-assessment is the underpinnings of the way that we go about preparing our tax returns. And as such, one of the problems that I would suggest is that it's not necessarily a compulsion, because as Lorne mentioned, what is blue to one person could be turquoise to another. And the reality is that it's very much the opinion of one individual. And the presumption that all people's opinions on one subject are identical is somewhat dictatorial and somewhat shocking, quite frankly. One of the contentions I would have is there's case law to support the notion that there isn't a requirement for self-assessment, but we're going further now. Now we're saying, oh, we have to give a roadmap to CRA in order to find what they may believe that we did wrong, even if we didn't. And that, I think, is a problem. So I'd suggest that, large companies that are confronted with these kinds of decisions need to obviously take this seriously. But by the same token, it's one of those situations where I believe might be more difficult to enforce. I'm thinking of some of the rules in the past, the purpose test as an example, that deals with paying dividends out of corporations in excess of a certain amount, which has the result of becoming taxable when otherwise it would have been tax-free. Well, we haven't really seen that been enforced. There's a lot of other things that has been talked about that's not been enforced. Is this just another one of those, or is this something that we all have to have a look at with somewhat of a subjective eye? Or do we have to be more objective? I look at this as an issue that is not a very welcome change, and it just makes the landscape a little bit more difficult to navigate. But nonetheless, good planning can be achieved with confidence, despite some of these challenges.
Okay, so let's now turn to the last topic of this first part, base erosion and profit shifting rules, or BEPS for short. The OECD, for the last number of years, has been concerned about the ability of multinational corporations and high net worth individuals to shift taxable profits from high tax jurisdictions to low tax jurisdictions without justification. And we now are seeing, I'm going to suggest, revolutionary changes in the international tax scene, which are being domestically enacted and incorporated in Canada and elsewhere, that we need to really be aware of and think about. This particular focus was generated by the huge profits of the digital companies, the Googles, the Amazons, and so on. And while many of them were American, and many of the complainants were in Europe, big market jurisdictions, they found that there was very little tax that the European countries were able to collect from these big digital companies. And so over the last couple of years, we've seen a number of countries introduce digital services taxes. Canada, in the 2020 and now 2021 budgets, has announced that it also wants to introduce a digital services tax unless what you see on the screen will actually be implemented internationally. And just in brief, a digital services tax in Canada would be a tax of 3% on the revenue derived from these very large corporations from sales into Canada. So these would include, for example, online marketplaces, matching sellers of goods and services with potential buyers. Another group of these companies, social media. So if there is online facilitation between users and transactions, revenue derived from that will be subject to the 3% tax. online advertising similarly. And then those companies that aggregate data online and sell that data would also be generating revenue. Overall, the company that would be subject to it would have to have at least in euros 750 million global sales, and in Canada 20 million of domestic sales, and then they would be caught by the digital services tax if it's indeed implemented. But the OECD has now gotten 141 countries to agree to implement Action 1, Pillars 1 and 2, instead of and to replace existing digital services taxes in France, UK, and elsewhere. The Pillar 1, very briefly, is a new set of international tax rules to allocate taxing jurisdiction differently than up until now. Right now, there has to be physical presence in a country before that country has a connection or nexus sufficient to justify the jurisdiction to tax. Canada has about 100 tax treaties with countries around the world, and they all provide, based on the OECD model, that there has to be in Canada a permanent establishment of that foreign corporation before Canada can impose tax. Pillar 1 would say, no, we're going to have two amounts. Amount A is going to be based on a nexus or connection simply of revenue derived in a market jurisdiction. Again, we're looking at very large companies with over 20 billion in global revenue. And what will happen is that a formula will be developed. We haven't seen it yet, just the words so far, but the formula will be a determination of profit in excess of 10% of the revenue from a local jurisdiction and an imposition of 25% tax on those residual profits. That's what the market jurisdiction will be able to collect based on this amount A. And then there's going to be an amount B where the international company does derive profits from marketing and distribution within the country, but there is a permanent establishment. So the combination of A and B will give, for example, Canada the right to impose tax on global companies where right now that's absent. And now we have to look around to the other 40 other countries that each one of which, if it imposes tax, is going to have this kind of concern for Canadian multinationals and the threat of double taxation and the lack of foreign tax credit symmetry is going to be very significant. And then finally, Pillar 2, and this, I'm sure the audience has seen a lot of publicity lately because the Group of 20, and now recently at the Global Climate Change Forum, the celebration of the fact that these 141 countries have agreed that there will be a 15% minimum tax imposed on global multinationals. So if Canada has had a policy for over 45 years to promote Canadian companies to expand abroad based on good business decisions, not based on saving taxes, we actually have a system that encourages Canadians to set up subsidiaries and carry on active businesses globally, and particularly in countries with which we have a tax treaty or a tax information exchange agreement. And Canada doesn't really care if the local country has a high tax or a low tax or no tax, in fact, so long as it's an active business. That's been the policy for 45 years. And it's been very helpful to Canadian companies to expand abroad and be competitive internationally. Well, that's all changing now. Canada apparently is going to say to the Canadian parent, if you set up a company that has let's say a hotel in the Bahamas that is generating active business income because it's a real business with significant costs and employees and so on, but there's no tax in the Bahamas, then the profits earned by your subsidiary in the Bahamas will be subject to tax back in Canada in the parent of at least 15%, even though there's been no attribution because it's not passive income, it's not FAPI or foreign accrual property income, and the dividend hasn't been paid back. So that's something that could be very concerning for Canadian-based multinationals. Where there is a foreign tax, that probably will be creditable against the 15% to avoid double taxation. But again, we're going to have to wait for the details to really see that. But I think these are two major changes that are taking place internationally, and Canada is right on board with these changes that we should all be aware of.
Thank you very much, Lorne, and thank you, Todd, for this all this information. It's great. We see some very broad and sweeping proposals by the government. So if you haven't called your tax lawyer, now might be a good time. We'd like to move on to the next part of our presentation. I'm sure a lot of our viewers are here to hear about Bill C-208. There's been a lot of talk about it lately. Before we do that, I'd like to open up a digital poll to see who our viewers are. Do we have business owners? Do we have advisors, students? Who's watching our program? So I'm just going to launch the poll now. You'll see it pop up on your screen. Just select which one applies to you, and so you can submit that. While you're doing that, maybe we would call on Todd to give some backdrop to Bill C-208.
Yeah, sure, Jeremy. For many years, there has been a rather limited scope of intergenerational transfer of wealth and prohibitions on certain types of planning if one would hope to benefit from, say, the lifetime capital gains exemption in family businesses. And often one of the difficulties we have, well, there's really two that I can think of that Bill C-208 deals with, but one of them would be where you have shares of a corporation that are held by a parent, as an example. This is the most common scenario. And then you'd have a holding company that would be held by children. And possibly over the years, there's been money that's moved up from the active business into the holding company. Well, 84.1 of the Income Tax Act had purpose that had the effect that if you were to purchase the shares of the father by the children's corporation, that you would not be qualified for a capital gains exemption. In fact, it would be treated as a deemed dividend, which is problematic to many of us who are working with wealthy families across Canada who have children and sometimes 2 and 3 generations. So I believe what may have happened here is that there has been a lot of hype over the last few months. And I've been getting calls from lawyers and accountants across Canada who have been asking for assistance to meet some sort of a deadline before November 1st, because there was a belief that this might be taken off the table. But I think what ended up happening was that it really isn't anything new. And that is where an individual is trying to establish a way in order to, say, gain tax advantages that were not intended by the legislation. And I think that people looked at that as, well, a window of opportunity. It's a loophole. Let's all jump on the bandwagon without stopping to take stock about the fact that CRA can still apply GAR. So some of the planning simply that we've been asked to look at, we don't agree with. Having said that, the spirit of Bill C-208 is one of a noble cause, and that is to assist families to attain transition of the business to the next generation, but in a legitimate way, not an artificial fashion. And this is one of the issues that we look at when you consider, is this really legacy planning? Are the parents really have actual control of the company, even though it has the optics that the children are buying the company. Well, maybe nothing much has changed other than names on pieces of paper and other things. So I'd suggest that this kind of planning is beneficial. Another feature of Bill C-208 is another prohibition that we've had, or I would just say restriction. And that is, we do a lot of purification, corporate purification. That means that we're able to move cash and other assets from company A to company B to create eligibility for the capital gains exemption and to create asset protection in case a company gets sued. And we're able to do this without tax consequences. Well, for purposes of Section 55 of the Income Tax Act, 55(2), siblings have been deemed to be unrelated. And the kinds of transaction I'm referring to is a related party butterfly transaction, which again, it's a very essential strategy, which is provided for in the Income Tax Act as a method, a means of achieving something that's critically important. But where you have siblings, well, couldn't work. But now in the context of small business corporations, active companies, well, we now have the capability to do that sort of planning, even though there are siblings within a corporation that both hold shares or both control the company. So I think that's a very welcome change.
Great. We have a diagram here of an example. Maybe Lorne, would you like to get into this a little bit, please?
Sure. The harm that the government is concerned about is a sale of the family business corporation to what appears to be the children's corporation, but what's really happening is that there's surplus of the family business corporation being stripped out and paid tax-free back to the owners, the entrepreneur, let's say. And 84.1 is the anti-avoidance rule that would say that the entrepreneur has not realized a capital gain, but is deemed to have realized a dividend subject to tax if it's viewed that what is being structured as a non-arm's length transaction. And so the amendment would expand the opportunity to be able to get a capital gain and not have the entrepreneur be deemed to have received a dividend if children's corporation at the top is controlled by adult children and they are intending to carry on the old family business. So in that situation, the entrepreneur selling the shares and being paid in cash, even if the cash comes up from the family business corporation by way of a tax-free dividend after the acquisition to the children's corporation, and the children's corporation, having bought the shares with a promissory note, now is able to pay off the note with the cash from that dividend. That could still be viewed as, or that will be viewed if the amendment goes through, or I'll rephrase that. If the amendment that went through remains unchanged, because the federal government is talking about modifying this carve-out. And what this diagram shows is who really is in control of the children's corporation. The children have put in $100 to get voting common shares, and they have legal or de jure control. But one has to look at the continuing involvement of the entrepreneur, either through share ownership, which I show on the diagram, or it could be contractually. And we'll talk shortly about a case where the relevant contract upset the planning in determining who has actual control of a corporation. That'll be relevant for our discussion here. But the point to get to keep in mind is that if we're looking at creating a transition plan or a succession plan, and we want to use a children's corporation, the children must be in real control. More and more, the federal government is going to be looking at economic substance, not just the names on a shareholder register and what appears to be the legal arrangements. We have to broaden our thinking. Can our planning stand up to scrutiny if the CRA looks at what's actually happening?
Okay, thank you very much. So let's move into this issue of control a little bit more and why it has so much to do with so-called C208 planning. I'd like to call on Michael Miller to give us some background on this case, Dean's Knight Income Corporation. Please, Michael.
Thanks, Jeremy. Dean's Knight Income Corporation is a case that was decided late this past summer. So it's very real, and it was decided in the Federal Court of Appeal. It addressed what the object, spirit, and purpose of section 111.5 of the Income Tax Act dealt with in the context of determining whether there had been an abuse for the purposes of the GAR. So the wording of 111.5 refers to de jure control test. That's the test they use, and that's the legal control of the corporation. In other words, the shareholdings. Who's got the shares? Who's got control? De facto control is not tied to shares, and it broadens a concept that focuses on the influence rather than the legal control. Who's really influencing what's going on in the corporation, even though they may not have majority of shares. So despite the prior thinking, it was common that if there's going to be a change in the control test, that would be something that Parliament, Jeremy, was going to look into. They would be the one to make the change, but the Dean's Knight case has changed that. They've adopted, that case adopted an expanded concept of control of 111.5. And that expanded concept of control is one that looks beyond the de jure concept, so that when prior cases such as the Dua printer case, when we weren't that concerned about GAR, and it didn't, sort of 1990, it didn't exist at the time. So what this case does, the Dean's Knight case, is takes us to look beyond the concept of de jure. And so the Federal Court of Appeals definition in this particular case of object, spirit, and purpose uses the term actual control. This is what Lorne's talking about, who really is in control. And that seems to take into account who's got de jure as well as de facto control. So it's possible that actual control is now going to be deemed to be something different than the other two. So if that's so, there's now a high degree of uncertainty about what type of control that could trigger a GAR assessment with relation to the misuse or abuse of subsection 111.5 and similar provisions. It's sort of up in the air. We don't know. We don't know what the Supreme Court of Canada is going to do. The Supreme Court of Canada has dealt with actual control in the Dua case, but what they deemed actual control to be is de facto control. This is different, and this will has to be decided because we don't know when GAR applies and doesn't apply now with regard to the control that Lorne was just talking about. Jeremy, I know we're short on time, but I just wanted to give a quick update to our Bitcoin followers, if I can, for less than a minute. Today, Bitcoin's at $60,000, a coin that's down from $69,000 just 6 days ago. So yes, Bitcoin has doubled since June, but the question is, what's the predictions for going forward? And it seems to be 50 to 75,000 seems to be the range, although some people are expected to be around 100,000 in the next year. Ether is also down about 7% today. That's my quick report. Thanks for having me.
Thank you.
Thank you very much, Michael, Lorne, everyone for your contributions. Just to wrap this up before we move on, you need to make sure that you're taking GAR into account when you're looking at taking advantage of the changes with Bill C-208 and you're planning with your family. So let's move on. We have another poll that we'd like to open up to everyone on the question of the capital gains exemption. There's a lot of confusion even amongst accountants and lawyers, business owners on the capital gains exemption and qualifying for it. A lot of people mistakenly believe that it's an automatic thing. Every person is entitled to their $800,000 and so of capital gains exemption every year. Not every year, but in a lifetime. They're not aware of the rules and qualifying for them. So I'd like to open up this poll and ask everyone which one of these situations is not going to qualify for the lifetime capital gains exemption. Okay, there we go. Okay, you can vote now. You're going to get a pop-up on your screen. We can see the results are coming in live. It's looking like a almost an even split amongst all of the answers. The one that's coming out on top right now is C. C is not being the qualified one. Maybe I can ask Todd just to give us some comments on qualifying for the capital gains exemption in general.
Yeah, as Jeremy said, there's not an automatic entitlement. Every individual is entitled to a lifetime capital gains exemption, but only if the shares qualify. Oftentimes what business owners, accountants, and lawyers tend to overlook is certain kinds of assets that are held by the corporation. So all of these scenarios are implying that there's an inordinate amount of what we call non-active assets, either cash, marketable securities, stocks, whatever, things that are not used actively in the business. And we see it all the time that people go ahead with B because they know they had a problem with A when the money was sitting inside of the operating company. Then they push the money up to the holding company and they don't realize, well, wait a minute, the only place that the business owner can claim the capital gains exemption is on the shares of the holding company, unless there's been other planning done. We see that all too often. And then we see this situation on C and basically a loan to the sister company. There are certain instances where we can seek relief to have indebtedness reduced to nil, where there's companies that are related, but notwithstanding that point, we see it all too often that loans are throwing companies offside. Unsuspecting business owners, accountants, and also lawyers that are working on behalf of some of their clients fall into a trap. And that is that there's just a presumption there that there's no problem with related party loans. And there's no problem with other kinds of assets being held. And by the way, CRA doesn't consider debt liabilities. They look at assets. So if you want to be safe, don't have more than 10% of your overall assets in the form of cash, which if it's too much, it's considered a bad asset, by the way, or other types of redundant assets. There's remedies for all of this, but I think the best answer is none of these companies could. Well, 3C might. I'm going to say it depends on all of them. It depends on how much other assets they have. It depends on whether they did an estate freeze in B, and it depends on, what that loan was for. So I'm going to say that we see this probably out of 10 successful companies that come through our door, where we see problems relating to some of these, at least 9 of them, as a general rule. So I think this is a very widespread issue. I think you need to look very closely at your shares. I had a lecture I did at the Ontario Bar Association when I asked the lawyers that were attendance for the state planning conference there, what do you ever look under the shares? And they had no idea what I was talking about. What I'm talking about is under the shares is on the trial balance, on the asset, the listing of various different assets. Try to determine whether or not there's anything to worry about. Well, how can you effectively transfer your assets to the next generation in order to do so in a tax efficient way without considering some of these issues. I think this is at the heart of what should be at the heart of what most estate lawyers, corporate lawyers, accountants need to be considering with their clients. And if you're a business owner, you may have to advocate for yourself, because this is can be serious. You may have multiple capital gains exemptions, not just one at 900,000. You could lose out on potentially millions of dollars of capital gains exemptions and unnecessary tax.
Thank you very much, Todd, for explaining that. If anybody missed it, the correct answer is all of the above. We had 30% say all of the above. After Todd gave away the answer, it went up to 32%. So
I was only guessing though, Jeremy.
yeah. So let's move on. Just a very brief solution to as a one-time purification for the capital gains exemption for the shares will qualify. What we can do, it's called a butterfly transaction, to transfer loans or cash from the opco to another company that's also owned by the same parent. And that will remove the inactive assets from the operating company so that they can then qualify for the capital gains exemption. We'll go through that quickly because we're low on time. We want to talk a few minutes now about family trusts and why we should use them. Maybe I'll call on Mayor Makki just to give us a little bit of background on the family trust.
All right, thanks, Chairman. I know we're running out of time, but just in keeping with purifying your OPCO and qualifying for a lifetime capital gains exemptions, if you have buildup of a lot of cash, one of the good ways to purify your company is by utilizing a trust, is do a flow through to a corporate beneficiary. Trusts are also, we think, very underutilized for asset protection. You've built up this great business operating company, and a lawsuit can bring you down. CRA, creditors, bankruptcy, internal creditors, marriages coming into the family. A family trust is great for all these things. And the reason for that is courts are very reluctant to interfere with family trust arrangements because they go back to the Middle Ages. So they're highly underutilized, and they're very good for asset protection, multiplying capital gains exemptions, and for tax planning.
Great. Maybe I'll call on Lorne. Lorne, would you like to comment very briefly on maybe some of the benefits of using a foreign jurisdiction for a trust in terms of asset protection?
Sure, very, very briefly. If one uses a typical Ontario trust, we're uncomfortable with the uncertainty, and that derives from the case law. There is a case that went all the way up to the Supreme Court of Canada, Mahyar versus Ottawa Wine Vaults, many years old, but repeated and affirmed in the last couple of years. It's still good law. And it applies the Fraudulent Conveyances Act in Ontario, very broad. If someone participates in an estate freeze and transfers assets, the purpose of which is to hinder, delay, or defraud in a civil but not a criminal sense, creditors, not only must that person be aware of current creditors that might be prejudiced, but ought reasonably to think about future creditors. That kind of uncertainty drives us away from using Ontario trusts, and instead we're involved more and more in doing typical estate freezes for Canadian businesses, owners of real estate, etc., through another jurisdiction outside of Canada. It could be in the Caribbean. We've done lots of them in Barbados, but we're working on others in Bermuda, Channel Islands, and the United States, setting up structures, say in Wisconsin, which is a very friendly jurisdiction for estate planning as well. And the benefit of choosing such a foreign trust is superior asset protection. Limitation periods are shorter. The ability to challenge is only looking at current creditors, not potential future creditors. And the other benefit that comes from our estate plan using a foreign trust is, Mayor mentioned about a corporate beneficiary. In this case, we would set up a Canadian corporation owned by the foreign trust. And in that corporation, we would have all of the investments resulting from the surplus that we are taking out of the operating companies and putting it into a safe place owned by a foreign trust. And the benefit of that non-CCPC, Canadian Controlled Private Corporation arrangement, is the tax rates on investment income are 1/2 of what they would otherwise be. Instead of 50% for ordinary income, is 26%, and for capital gains, instead of 26%, is 13%. So driven by superior asset protection as the motivation, we set up these asset protection trusts in better jurisdictions, and the natural consequence is significant tax savings for the family.
I'll just
Jeremy,
add,
can I just add, if we just take a look at what happened at Astro World last week, that terrible tragedy, there are many multi-millionaires involved in that behind the program and performers. They're going to be wiped out if they're not protected this way. You cannot have enough money to cover the hundreds of millions of dollars in lawsuits that are going to be brought forward from that.
yeah, just to clarify as well, I wanted to make the point that the Fraudulent Conveyance Act is not only in Ontario, but it's in all provinces. And this wording that Lorne had cited, that is, if you're attempting to hinder, delay, or defraud a creditor, has long-reaching consequences that could have the effect of piercing a corporate veil, breaking a trust, or accessing other assets. Also, in the 2021 budget, of note is that Section 160 of the Income Tax Act will be broader powers and further reaching effects of CRA to access funds that ought to have been used to pay taxes. So this whole concept of asset protection, I think, has never been more important than it is today. And when we look to go outside of Canada to set up trusts, whether it's in Caribbean or the US or wherever it happens to be, please don't misunderstand. This is not an aggressive tax play. We're not sending money there. Not a single dollar is sent to these countries other than to pay a corporate trustee his fees. And all of the assets of the trust, the beneficiaries, are the only ones in law that have any right to those assets, and no one else. And we're not taking advantage of low tax rates in these jurisdictions. We are paying tax on the company that Lorne referred to, where investments are held as this corporate beneficiary. We're making investments in Canada or where we want to, but we're paying tax in Canada, always. Never a situation we're not paying tax. But since there's a legitimate issue over the control of the company being shifted to another jurisdiction with the purpose of achieving this asset protection, the result is that it ends up being a non-Canadian controlled private corporation, having a tax rate instead of 25% on capital gain, a little over 13%, instead of over 50% on the general rate passive income taxes, 26.5%. So there's very, very strong benefits without the risk of doing something that's profoundly aggressive, which we will not do.
I'll just add one final point to what Todd is saying. The trust is going to be deemed to be resident in Canada for purposes of computing worldwide income. And so it will file a T3 tax return every year, just the same as an Ontario domestic trust would do. It is not an attempt to set up an offshore trust that doesn't pay tax.
And all of these continuances that people have been doing are definitely on the radar, meaning that we take a company from, say, a Canadian province and we continue it into another jurisdiction. Well, that's aggressive planning and it's artificial. There's no clients there in BVI or Delaware or wherever you happen to transport the company to. There's no employees. There's generally no presence there and no reason other than one, and that is tax avoidance. What we're talking about here is very legitimate reasoning for establishing the trust. And what makes this optically and otherwise very appealing is what Lorne had just said, and that is where it's a Canadian taxpayer. It's what's called the NERT, non-resident trust, under the deeming rules in Section 94, the Income Tax Act, which files a Canadian tax return, a T3 right here in Canada, even though it may be held elsewhere. This is something isn't enough time to talk about today, but it's a powerful, powerful tool in the tax planning arsenal, and strategic advantage that it gives is remarkable as far as helping to pass the assets to the next generation.
Thank you all very much. As the audience can probably tell, we love talking about trusts. One of our favorite topics. We just scratched the surface today. If you'd like to talk about trusts, we love to talk about trusts. We're going to open up for questions in just a couple of minutes. There's one last topic that we're going to touch on very briefly. We promised to talk about some planning strategies. We did talk about trusts. We're going to talk about one very briefly that uses life insurance as a strategy that's integrated with a corporate reorganization. It's a very interesting strategy that some people are maybe aware of, others may not. This is a strategy that is able to enhance the cash flow that a business owner is taking. The way that it works is a company would buy a life insurance policy on, in this case, it would be on the business owner's life. The company would be the beneficiary of this life insurance policy. In this case, we're saying that there's a $1 million annual premium. And that sounds like a lot of money because it is a lot of money. But you'll see if you, in a minute, why you're taking such a large annual premium in this case. So in this case, the business would take out the insurance policy on the business owner's life. Then the insurance policy would be pledged to a lender. And we often use banks such as Scotiabank as a lender on these types of deals. The policy would be pledged to the bank as collateral. Then the bank would issue a loan to the business owner in the amount of the premium. In this case, $1 million, with the goal to do the same every year. So the company would put $1 million into the policy. Then the bank would issue $1 million loan to the business owner on a year after year basis. So the business owner is receiving some cash flow in the form of a loan from the bank, and loans are not taxable. There is interest that you pay to the bank, obviously. And in this case, there are some concerns that the tax people watching may have, like saying, well, if the business owner is receiving a loan based on a corporate asset, there must be a shareholder benefit under the Income Tax Act. Well, to make sure that we're avoiding a shareholder benefit situation, we would have the business owner pay a guarantee fee to his or her corporation of the amount of 1.5% to cover the use of that asset that the business owner is using to take a personal loan from the bank. But this is one of many ways that we have in our toolbox that are compliant ways for business owners to be able to increase the cash flow that they're receiving. This is the last diagram of our presentation today. It just shows what happens when you die if you're taking that kind of a plan. So what happens is you have this life insurance with a very large death benefit. It pays out to the corporation, and the first thing it pays is actually the bank. So the outstanding loan that you're taking every year, let's say you took $1 million for 10 years, now you have a $10 million loan. Well, maybe you have life insurance with a $20 million death benefit. The first $10 million pays off the bank. Then you're left with $10 more million that goes into your corporation, and then it actually pays through to the estate tax-free up to the amount of the available CDA. This is a capital dividend account. So that's the money that can come out of your corporation tax-free. So this is a situation where you're not paying interest and you're not really paying the bank until after you die. It gives you year after year benefits, and it can even benefit your estate after you pass away. There's other things that we didn't have time to talk about today. These are just a couple of situations where we may be able to, there's lots of things that we can do to assist wealthy and successful business owners, as you can see in examples A and B. That wraps up our presentation. Thank you, everyone, so much for being generous with your time. We went a little overtime today because we had we packed in a lot of information into a short period of time. Now we'd like to open the floor up for questions, if anybody has them. So I'm looking in the question and answer section. I have a question for Lorne. Lorne, did you answer this question already from Dave Banab?
No, not yet.
So the question is,
The question is, can I be more open about what I said, that some of those changes are political? Everybody's familiar with, most recently, Pandora's Box. Previously, it was the Paradise Papers, etc. These are disclosures globally of the apparent tax evasion by prominent people, politicians, celebrities, and so on. And when the newspapers and the media jump on the bandwagon, the public gets very concerned that there is a huge amount of income not being taxed that could provide for health care, for child care, to cover the huge expenditures we've incurred in connection with the pandemic and so on. And so there's a lot of political pressure being exerted as a result of these disclosures, and I'm going to suggest way overblown. And the government is reacting to this populist initiative by coming up with ever tightening rules, making Canada a more difficult place to do business domestically and internationally. And just to repeat a small point that I made earlier, for those of us who've been practicing for years, in fact, there was much more aggressive tax planning years ago. It is diminished substantially. And what you're hearing today from us is planning to take advantage of opportunities within the tax system and to be compliant. We want to be compliant on the lowest reasonable basis, because everybody is entitled to plan his or her affairs and minimize tax so long as it's done legitimately. But I get concerned that with the overshoot of government running roughshod over privacy rights, so over requiring all sorts of things that we've talked about today, being very much driven by political rather than economic and proper tax policy reasons.
Jeremy, I was wondering if I could maybe address one of the questions on insurance. There were two questions.
please.
No, and I believe the questions related to presenting a problem by keeping a life insurance policy in a company that may be sold. Or another question was, well, doesn't that cause the loss of the capital gains exemption? I did a lecture in Vancouver before COVID-19, and I was invited by the head of a large insurance company to lecture in 4 different cities to all their top brokers, because in their words, none of their agents are doing it right. Well, I'm not saying that's true. That was what it was told to me. Now, one of the problems that we see is the transportability, because when you transfer a life insurance policy, stock portfolio, or any other asset, there's potential tax that is triggered when that is done. So when a life insurance policy is placed, agents that are putting them inside of a holding company on top of an operating company, my message is please stop doing that if you're intending to claim a capital gains exemption, unless there was a freeze done at the bottom level. That happens all the time. And all those of you that are in the investment business that are selling marketable securities, again, let's pay attention to these very important rules. You might argue, well, He already had non-active assets, but please don't add to the problem. If you're a business owner that has life insurance policies or marketable securities, cottages, condominiums, anything that's not active in your business, it's a very important issue that we could actually help you to address that is often overlooked. And there's ways of moving them. And one question from the audience is, well, doesn't that trigger tax? Well, the answer is it depends. It depends when it's done. But if it's done right in the beginning, in other words, if you build a structure and the structure is flawed, and many structures we see are, well, the last thing you want to do is add to that structure. You do not have the structural integrity to support an addition. If it's a corporation and a trust and a life insurance policy, well, that may sound really simple, but the answer is punitive. And if you build this structure and you add on to it, let's fix the flawed structure before you add to it. Don't just buy or sell life insurance policies in order to achieve what may appear to be a good idea. If you don't do it right, you shouldn't do it at all. And one of the main parts to that puzzle that a lot of people are missing is a single wing butterfly. You have OpCo or HoldCo here, you've got a Cisco over here. Well, you can move the money tax-free from OpCo or HoldCo over to Cisco. And then we can, that's only one piece of the puzzle, many, many more. But I just, every time I look at structures that have been put in place, I think of the words of this executive of this insurance company that said all of his brokers are doing it wrong. So I think it's a wake-up call to the industry, and any business owners who are concerned, you have reason to be.
I apologize if we weren't able to get to answer your question today. We're out of time. But if you'd like to contact us after the presentation, you'll be receiving an email and you can reply to that, and we'd be happy to answer any of your questions. We'd like to thank all of our viewers for attending today. Thank you very much. And we'd also like to thank our expert panel for providing such a wealth of knowledge and information. So thank you to everyone, and we'll see you at the next webinar.
Thank you.
Jeremy, I just want to ask you, is it true that you named your daughter Trust?
That's her middle name.
Well, bye.
Very good. Thanks. Thank you, everyone. Thank you. Bye-bye.